Taxand Tax Updates, Issue Number 1, March 2023. Key points regarding the 2022 Annual Individual Income Tax Returns. Harmonization of Tax Regulations Law Number 7 of 2021 stipulates that individual taxpayers have an obligation to report annual tax returns, and underpayments of tax payables must be paid in full prior to the annual tax returns being submitted. Therefore, if there is a delay in the submission of an annual tax return, the taxpayer will be subjected to a fine of 100,000 rupiah. Additionally, an individual taxpayer will be subject to administrative sanctions in the form of interest at the monthly interest rate determined by the Minister of Finance for the amount of underpaid tax calculated upon the end of submission of the annual tax returns up until the date of payment, and will be imposed of such sanction for up to a maximum of 24 months. If an intentional reporting of incorrect or incomplete annual tax returns is made, effectively causing a loss for the state revenue, such a case may result in the imposition of a criminal sanction of imprisonment of 6 months up to 6 years, as well as an administrative fine of 2 to 4 times the unpaid or underpaid tax. However, if unintentional, the taxpayer will be subject to a fine of 1 to 2 times the tax payable that was unpaid or underpaid, or will be subject to imprisonment of 3 months up to 1 year. To avoid this, every taxpayer must ensure that the annual individual tax return submitted is correct and complete within the appointed deadline. The reporting deadline of the annual individual tax return for the 2022 fiscal year will be by March 31, 2023 at the latest. Sources of data that can be used to facilitate the preparation of tax calculations in the annual individual tax returns include a list of assets and liabilities consisting of the following: from the company, an SPT 1721 A1 or A2, and withholding slips for income tax returns. Also from the company, the amount of share subscription based on the company deed, receivables or payables of the shareholders. From insurance companies, annual transaction reports containing the ending balance of the unit, along with information regarding payments throughout the year. From securities companies, stock or bond portfolio reports which contain the year-end balance based on the purchase price or average cost, sales and purchase reports for 1 year, profit and loss report on sale of shares, and corporate action reports containing information on total cash or stock dividend income for 1 year. From property companies, a sale purchase agreement. From financing companies, a credit agreement. From domestic banks, a consolidated report or portfolio statement containing a year-end balance information, total interest income and total taxes that have been deducted for the year, and credit agreements. As for foreign banks, statement of account, income or investment report, which contains information on the year-end balance of assets based on the purchase price or average cost, total interest dividends, bond coupons received, and related fees for the year, the calculation of profit and loss on the sale of assets, and credit agreements. From foreign tax offices, or IRAS, a notice of assessment. Other documents may be in the form of a family card or a statement letter of parental dependence, and others. In the Director General of Taxes Regulation number PER 02 PJ 2019, it is stipulated that an annual individual tax return reporting can be made through an e-filing, direct filing, postage with proof of mail delivery, or forwarding service companies or courier service with proof of mail delivery. Furthermore, the dividends received or obtained by the individual taxpayer are excluded as income tax objects if they meet the following conditions. They must be derived from within the country or originate overseas, given that they are from an overseas business entity of which the shares are traded on the stock exchange, or from an overseas business entity of which the shares are not traded on the stock exchange in accordance with the proportion of share ownership invested of at least 30% of profits after tax, or invested before the DGT issued the tax assessment letter on the aforementioned dividend in connection with the application of Article 18, Paragraph 2 of the Income Tax Law. Upon meeting such conditions, the dividends may be excluded as income tax objects given that they are invested in the territory of the unitary state of the Republic of Indonesia within a certain time period in accordance with the Minister of Finance Regulation Number PMK 18 PMK 03 2021. Therefore, the individual taxpayer must directly report an investment realization report of the 2022 fiscal year by post or through a freight forwarder or courier service company with proof of mail delivery by no later than March 31, 2023. If the individual taxpayer does not perform an investment realization and within the investment period, as intended in Article 34, Article 35, and Article 36 of PMK 18, then the income tax payable will be imposed at a rate of 10% upon the receipt or acquirement of the dividend. Disclaimer: the information contained in this document is intended only to be a guide. It must not be relied on in or applied to specific situations without previously seeking proper professional advice.